Hello, Internet. My name is Ryan Ingram, and today we're going to talk about private money, how to raise it, where to find it, and we're also going to talk about creative ways to get involved in real estate investing because there are a few key things that I think often go misunderstood that I want to clarify. I get a lot of questions about, especially when I talk about how I finance properties, because I borrow money from friends and family at 10 and 12%. And a lot of times that's misunderstood, and people think that I just have these absolutely just god awful loaded people in my network, which isn't true. So when we're talking about private money, there are a few things to note. So the first thing about private money is that yes, friends and family have it, and you should never borrow private money from someone that is not a friend or a family member. And the reason for that is the SEC. They are giant, they are massive, they're similar to the government in that they will crush you if you violate any of their laws or statutes. So you should most certainly familiarize yourself with those laws and the appropriate legal way to raise private money from people that are not in your family or your friend network. Because if you are out there soliciting, attempting to raise money from people that you do not know, it's technically a security, and there's a giant gray area slash tons of just black and white laws that are now applicable to you that could really hurt your pockets. All that to say, only borrow money from friends and family. And when I say friends, I mean people that you have a proven track record with. If it ever comes up into question, then you have to prove how you're acquainted with them, how many times that you talked before you ask them for money. So email threads, how you met them, where you met them, when you met them, all of that is extraordinarily important if you are borrowing money from somebody that you're not familiar with. So, moral of the story, friends and family only, nobody else. All right, now the second thing that's really important about borrowing money is anybody can be a lender. You have to familiarize yourself with your state's laws. Each state has their own. They're called usury laws, and that limits the amount of interest that you're able to give people or that people are able to charge you. Because the last thing you want to do is accidentally run an illegal operation. You don't have to have any sort of license to either borrow or lend money on like a peer-to-peer basis. So just one person to another person outside of any corporation or bank. And how people give you money is largely dependent on where they have the money stored. So if somebody has money that's in like a CD or a savings account, then you can just go through that person, and any of the interest that you give them is taxable just like any other income that they would get. So I'm positive that somebody in your circle of friends or family has like 10, 20, $30,000 just sitting there in some account that isn't earning them much interest, that is also apart from their emergency fund or savings that they're truly attached to should something go wrong. Now, Matt Faircloth of Bigger Pockets has written a book called Raising Private Capital. I would highly recommend reading that just to get a thorough grasp of private money. But the cool thing is everybody has the option of turning their former retirement accounts into a place to lend money to someone like you who's looking to utilize it in real estate investing. And when I say former retirement accounts, I mean anytime somebody does like a career change, let's say they're in law enforcement and then they go into something like insurance. I don't know anybody that's done that. I took out all of my retirement funds and I put those into a solo 401k at first. So I rolled those over. Now, ultimately, yes, I cashed out that 401k, but the only reason I did that is because I was comfortable paying the surrender taxes and all of the penalties for doing that because of my age. I was 27 at the time. If I were older or closer to retirement, I never would have done that. But I much rather would have paid the penalty rather than abiding by all of the rules, because there are a lot of rules that you also have to familiarize yourself with. If you're recommending that somebody roll over their funds into what's called a self-directed IRA or a solo 401k. Now, the two major companies that I'm familiar with are called Quest Trust Company and Equity Trust Company. I'll put the links to those places below so that you can check them out. They have tons of educational information that you can use to learn about how to do this and how to pitch this to other people. But the second thing that's also most important is anybody can do it, but you are the one that's going to have to educate them on how they can go about doing it. So if you want to get your hands on private money, then you have to go about and pick up the burden of learning all the ins and outs of this, what you can do and what you can't do. That way, when you are approaching people to try to find private capital, all again in your friends and family network, then you're going to have the means and the knowledge to articulate exactly what it is that they can do to unlock a higher interest rate. I pay my investors anywhere between 8 and 12%. And the reason for that high discrepancy is just the amount that is borrowed, the time length that it's borrowed, and how risky that particular investment may or may not be. So those three resources, Equity Trust, Quest Trust, and also Matt Faircloth's book, that is a phenomenal starting place for you to start learning about exactly how to go about doing this. And naturally, once you start talking about real estate investing, once you get your feet wet with a property or two, and you start just absolutely running your mouth to everybody that ever talks to you about exactly what you're doing, then over time of just constantly talking about it to people, they're going to become more confident in you. And then you can slowly start talking about the idea of potentially lending you money. And sooner or later, between the people's confidence, their familiarity with you, they are ultimately going to become comfortable with lending you that money. And then before too long, there's this giant snowball where now you're giving them interest rates at 10 and 12%. They're telling their friends and they're telling their friends' friends and they're introducing them to you. And you are not violating any SEC rules because you make them friends before you actually borrow any money from them. Which all comes back to Dale Carnegie's classic How to Win Friends and Influence People. I can't stress enough how incredible that book is and how much money that book has made me in a very short amount of time. So read it, reread it, and then read it some more because your future depends on it, especially if you want private money. So that sums it up about private money. The last discrepancy that I want to make, or distinction that I want to make, is that I'm not talking about hard money. So there are companies that give what's called hard money. So they give you money at higher interest rates, but they also charge you points. So if you're raising money from friends and family, then you're not paying any points. If you go through a hard money lender, then you're going to pay points for like the origination fees, and you're also going to have tons of other costs. I don't know. I just think hard money is really expensive. I have yet to use any because 4 points adds up pretty quick because 4 points is 4% of the deal. So if it's a $100,000 property, then you're probably going to pay somewhere around $4,000 in order to gain access to that money that you're then paying 10 or 12% on. So my distinction between private money and hard money is that hard money has points. Now it can come from people that you don't know. It doesn't have to be friends and family at that point. But if you go about and do your own kind of networking and marketing and telling and educating your friends and family, then you're going to be able to circumvent those points, essentially saving or making you those points that you would be giving a hard money lender. It's totally a matter of perspective and how you look at it. Now, the other topic that I wanted to hit on is kind of an introduction to creative financing, because there are so many different ways to be creative inside of real estate investing that can make you hundreds of thousands or millions of dollars once you familiarize yourself with them. Now, these take a lot of hard work, a lot of research, and a lot of like active energy. So it's not the passive income that a lot of people are talking about whenever they're referring to insurance. No, whenever they're referring to real estate investing. But over time, once you get a lot of these creative finance deals, then yes, it will turn into passive income, but there's a large time and energy commitment on the front end. Okay, now there are hundreds of real estate gurus that teach you all about creative financing, and this is a very broad topic. It could mean buying a property with traditional financing, but having the seller carry the 25% that they want you to put down on a separate note. So I've done this a few times where I have approached a bank, we got a traditional loan on the property, and then we took out a second mortgage on that property with the seller. But the second mortgage was on a different property, not the one that we just refinanced. And the whole reason that I did that is because we had other properties with more equity in it than the property that we just purchased. And I recorded a video about that deal in particular, which you can watch here. So please check that out. I would greatly appreciate it. So we're just going to call that traditional plus because you are getting a traditional mortgage on the property, and then you are adding a creative financing option with that seller. Now, the second option you have is you can do complete seller financing. And in that situation, the bank is not involved at all. You're just approaching somebody that has a property, and that property has become a burden. They somehow inherited it. They're trying to ease their tax burden, and they don't want to take all of the capital gains at once, so they're going to slowly sell it to you over an amortized period. That's a possibility. There are hundreds of different ways you can go about finding ways to add value to somebody that has a property that will result in creative financing with you, because you're taking the responsibilities of the property away from them, and they're still getting that monthly income that they have become very accustomed to getting throughout their time of owning that property. Now, I would like to point out that there are largely two different types of seller financing. The first is a land contract. Now, on a land contract, this is kind of like having something on layaway at Kmart. So flashback to the 90s. And not really accurate, because layaway meant that it was behind the counter and you couldn't play with it until you paid it off. With a land contract, you get all of the benefits of having the property, but you just don't have the deed. So the current seller is going to stay on the deed of the property, which means if you go into the auditor's website or look up the owner's records of that property, your name won't show up. It'll still be the seller's, but you should file the land contract, that is a legal document, with the county auditor or the county records, because you don't want that seller to do anything kind of funky and then have it on land contract with a few different people. So you're definitely going to want to get legal advice before you actually do a land contract, just because it is a little bit complicated. So on a land contract, just to reiterate without that silly Kmart reference, is on a land contract, you have the ability to, and you have all access to the property. So you have the keys, you can place tenants in there, you can occupy it yourself. You could rent it out, you collect all of the rent, you give the seller a mortgage payment, but that is all the seller is entitled to, is just that mortgage payment. You carry the insurance, you pay the taxes, and all of those things. And the reason that that is helpful is the seller might not require as hefty of a down payment as a bank would. You could probably, this is all just negotiation, and it comes down to how well can you negotiate. You might be able to put 5% down or 10% down and then get a property or several properties from the seller. So I task you with doing some research and finding articles about land contracts. You're probably going to find very good examples of land contracts, and then you're going to hear horror stories about land contracts and how people just lost tons of money. So you're definitely going to want to familiarize yourself with all of the ins and outs, because it is a legal contract, it's a legal transaction, and there are ways that it could go really south if there's not a high level of trust between the seller and you. Now, the second way that you could do seller financing is you can actually take title or take the deed immediately, and then the seller would become the mortgage holder, or he would own the note. So the seller would not own the property anymore. You would own the property, but they have the mortgage or the note. So in essence, they become the bank, which is beneficial to you because you now have full legal right to the property. There's no, well, it's my property, but he owns it. It's just, nope, your name is at the county records on that property, on that parcel. That property is yours. So now, if the seller wants it back, they have to go through the formal foreclosure process, just like a bank would. Now, in both of these seller financing options, the terms are negotiable. So in this, there are three items that you're going to want to negotiate. That's the purchase price, the percentage, and the amortization. So for the purchase price, generally seller financing, you can charge a premium for the property because no banks are involved, because the seller is being generous, because they are willing to kind of circumvent the bank, go out on a limb and trust you. That comes at a price. So you're probably going to pay a higher price for the property unless you're going to pay a higher interest rate. So normally the cheapest money that you can possibly borrow comes from a bank, like a Huntington, Bank of America, Chase. And then if Fannie Freddie gets involved and it's a government-backed loan, then now the interest rates go down to, I've heard somebody getting a 2.75% loan on their personal residence's mortgage recently. That's crazy. You're never going to find that in seller financing unless you just hit the jackpot. Then you might be able to. But nonetheless, because the seller's doing a favor for you, you can get pretty flexible between these two. If there's a higher purchase price, then you should negotiate for a lower interest rate. If you are getting a higher interest rate, then you should negotiate a lower purchase price. And the last variable is the term, or the number of years, or the amortization period. Now, if the contract is amortized, then the number of years that the loan is over greatly impacts the actual monthly payment amount. If this is an interest-only loan, then the number of years is inconsequential, really. You're just going to want to give yourself enough runway if it is interest only, so that you have an ample amount of time to go about getting a refinance done with a traditional bank. And you're going to want to give yourself, I think 2 years is probably pretty safe. I would go for 3 to 5 years just to make sure that things could go really sideways, both in the market and in your personal portfolio or with the banks, so that you have tons of time to not get stuck with a balloon payment, and you are able to refinance and pay off that seller with a traditional loan. So when you're out there negotiating for seller financing, a general rule of thumb is the seller can either have the purchase price or the terms, but never both. So if you have a higher interest rate and a shorter number of years, then you should have a lower purchase price, and vice versa. So if you are approaching someone to negotiate for seller financing, then those are the things you're going to want to keep in mind, because at the end of the day, it has to be a win-win. Don't just blindly accept a seller finance deal just because you have the ability to do it. You're going to want to make sure that over the 30, 40-year period that you have, it's still a phenomenal deal. And in the short term, it performs either in cash flow or heavy appreciation if you're able to get it at a giant discount and add value to it. If there's a lot of deferred maintenance, you could fix those for not much money and then have $40,000 to $50,000 of equity. Then that is a phenomenal deal in the short term and the long term. All that to say, don't get giddy just because you learn new things and you want to go out there and get a seller finance deal. So if you have any questions, if you want any points of clarification, please do not hesitate to ask. I am here. I'm committed to answering all comments, all questions. And if the question is good enough, I'll even make a new video about it, because at the end of the day, I'm here for you. I want to help you succeed in all that you're wanting to do. All that I ask is that you subscribe. Thanks so much. Can't wait to talk to you guys soon. Thanks.